Welcome to Geared for Growth. I'm your host, Mike Mortlock from MCG Quantity Surveyors. Today I'm joined once again by Bret from Metropole, a long-time Brisbane market specialist. And Brisbane has had an extraordinary run over the past few years. And in this episode, we unpack where it actually sits in the cycle now. We talk about what has really driven the growth, from job creation and infrastructure through to affordability ceilings and the Olympics narrative, and whether there's still runway left. We also tackled the question most investors are asking in 2026. If Brisbane is getting expensive and your budget is not north of 1.1 million, where do you go next without chasing a short-term sugar hit in a regional market? Bret shares his views on investment-grade locations, the importance of owner-occupier demand and land value, and why Melbourne and parts of Sydney may be the smarter contrarian plays to get into right now. Let's get into it. Bret Warren, thanks for joining me back on Geared for Growth.
Always a pleasure, Mike. Always good to catch up, and obviously another big year coming up.
Well, I mean, that begs the question, doesn't it? Because you're a Brisbane man, and you're obviously from Metropole, which I suppose, you know, a lot of people might kind of think the genus of that is very sort of Melbourne centric, which I suppose is fair. Yeah. The last time we caught up, it was probably when Brisbane was really starting to get some momentum. Yeah. And gosh, I don't know if anyone could have necessarily predicted how long it's been going for, and it doesn't seem to be stopping. And we were sort of talking off air about it used to be the case that, Melbourne's just too much, like we're going to buy in Queensland, but now it's like, well, Brisbane's so expensive that maybe all the Brisbane buyers have got to go back to Melbourne. Where are we at in the cycle? What's going on?
No, good point. Let's go back to the start and unpack it, because I remember, 2018. I mean, I'm talking to clients, and it's Brisbane's time. Something will happen. It's got to. I mean, Brisbane performed. I think it did about 60% roughly from 2010, 11 to 20. We started off with the floods. There was obviously the credit crunch. There was natural disasters in Brisbane. To be honest, Mike, as you know, it's the best place in the world to live. But no one's going to move here unless they can get a job, right? So that was the big issue. There was no jobs being created. In fact, we had a lot of mining slow down into the north of our state, and that kind of, exacerbated things, and there was just no jobs being created. But once we kind of got to 2020, there was actually 200,000 jobs between the CBD area and the airport. We had the Queen's Wharf project, the Cross River Rail tunnels, which are working, all the bridges, and also the second runway at the airport. And then obviously we ran into COVID, and that kind of just, I guess, was the icing on the cake and really sped things up. And all those people looking to move, they actually now had job opportunities. And that just created this huge wave of momentum where Brisbane, like I said, had not done a lot for 10 years, and all of a sudden it's done exceptionally well. So, yes, if you're looking back over the last 5 or 6 years, I think we're up towards about 90% at the moment, Mike, and they're tipping by the end of the year to be 100% growth in that period of time, which is quite amazing. But if you average that out over a 15 or 16-year period, it's really just normal standard growth. And I guess we get to that point now where, okay, we are getting to the top of that cycle. I don't see it slowing down, to be honest, in the next 12 months. But I think, again, if you're looking at incomes and wages compared to inflation and cost of living and interest rates, that affordability is going to stop this cycle. I think, like I said, I think we've got another 12 or 18 months here. We'll probably get more interest rate rises because of inflation. And I think that affordability issue will just really bring Brisbane back a little bit. But gee whiz, we've had a massive run. And myself and a lot of other agents are probably starting to get a little bit nervous at the moment, particularly when we see, looking at apartments. We missed out on a 2-bed apartment the other day in Brisbane, about 6 or 7 k's from the city, for about 850,000.
Wow.
And from where I started buying property in Brisbane in 2010 for houses for 380,000, it's quite a leap, quite a journey, Mike.
Mm-hmm. Interesting. You highlighted job creation as what I suppose you've identified as the big factor that has led to the growth. And I think like people, they focus a lot on population, but at the end of the day, it's household incomes and how close to their ceiling are they getting before, it sort of dictates how much the property markets could go. There's obviously been quite a lot of work. There's the big casino, the runway, as you mentioned, but and the other one, maybe you purposely left alone, was the games, because that was the big one. Brisbane's got the games, so everyone's got to go into Brisbane, but then there's a lot of commentators saying, look, a games does roughly bugger all, but sentiment actually counts for something, and sentiment can drive markets to some degree, especially investor markets, right?
Yeah, exactly. And look, I probably didn't leave that out. I mean, we were talking obviously previously. That's only really just come up on that radar. And again, that's always like, well, what happens next? Like with areas that have games and have those job spurts. Well, now the games is a big thing for Brisbane. But the thing is with that, Mike, it's still 6 years away. Every property spruiker in Brisbane and around the world will have you believe it's next weekend. And they're pushing their product and their prices. And look, I can't help but think, yeah, look, that's going to have a massive play in Brisbane, and it's great to set yourself up. But, the market's not and can't keep going at 10 or 12% per annum for the next 6 years. So I suspect, and if I get back my Nostradamus hat back on, I think it'll probably slow for that 2 or 3 year period in the middle between that, allow wages, affordability, and things like that to catch up. It's not going to go backwards. It'll slow, it'll catch up. And again, that jobs boost, just like it did in 2020, will happen again leading into the Olympics and create opportunity and demand for housing and things like that as well. So it's a great time to get set, but I'm not buying into the hype of that it's going to continue for the next 6 years, if that makes sense.
You mentioned household incomes, and I can remember looking at a research project, and this was maybe 23, 24, where Perth had done a couple of years of growth, and people are trying to pick the top of the market. And I guess this is the question for Brisbane at the moment. But in that metric, the household incomes to asset price ratio was still very healthy in Perth, because people in Perth get paid a fairly high amount of money compared to the country. It sort of begs the question, how much room have we got with household incomes in Brisbane to support further growth? Is Bret Warren calling this the peak of the market?
Ooh. Yeah, look, it'd be a brave man at the moment, I think. Look, I'd give it to if we had this discussion this time next year, I think I'd be a lot more comfortable looking at some of the information and data. But again, I'll probably call it in 12 or 18 months' time, but I wouldn't call it now. But yeah, I think we are getting to that point now. I think we're right on that notch now. The reason we've had that affordability is because a lot of people have moved up from down south, and they've had those incomes that have stretched further. But that's now kind of reduced and just kind of back to normal. But there is still money out there. There's still, I know it's a tough time for a lot of people. There's still people doing very well out there. There's also an element of emotion at the moment, and people are probably getting above where they want to be, and that makes me a little bit nervous as well. And I think we are getting close to the top of the cycle in Brisbane. So you've just got to be very careful with where you're buying and what you're buying, and likewise in the regions. I mentioned before in that 2010 to 20 period, Brisbane grew about 50%. Well, the secondary locations and regions probably didn't even grow 10 or 20% during that time. And now they've had this exceptional boom for the last 5 or 6 years, and I'm still hearing people talking about getting into, external regional areas and centres as well. And look, they probably may have another year or 5 years of growth left. I don't know. But what happens in the next 10 years after that? They've had that run, the good, consistent growth. I just don't see it happening in those locations. So you've just got to be very particular about where you're buying, because, again, it gets back to cost of living, household pressures and incomes. And those areas are really, I guess, fixed with their incomes, and they're not as I guess, elastic as other locations.
I do want to talk about Queensland's regions, because it's a bloody big state and there's a lot going on there. But if we are focusing in and around Brisbane surrounds, what sort of price points, what are the investment grade things that you're happy to sort of put your name to say, like, this is a belter?
Yeah, look, at the moment, the only thing I'd be comfortable buying at the moment is a house in Brisbane. And Brisbane isn't 40 k's from the city. Brisbane is the city of Brisbane, roughly up to about 15 k's north, south, west. That's where I'd be comfortable buying at the moment, because even if you're at the peak of the market comes back or slows a little bit, in a 10-year time frame, it's actually not going to matter. You're going to get into an amazing location. I guess apartments and things like that worry me a little bit. Villas we don't have a lot of, so they're great investments. Some townhouse complexes. I know probably 10 years ago we went through that oversupply of apartments.
Yeah, seems funny to talk about now, doesn't it?
It seems crazy when we're right around, but Mike, I believe that'll come around again at some stage. It's just a cycle; it always will. But houses won't. They won't go. There's a limited supply, limited stock. So I'm more than comfortable. The entry price for a house now is probably getting towards 1.1 million in those areas to $1,050,000. I guess anything under $1 million, I just don't see value in Brisbane anymore. You'd have to have an exceptional case, or maybe you've got assets in other states to get into Brisbane. But if you're coming into something between 600 and a million, there's not a lot of value in Brisbane. You're looking at a 2-bed apartment, 7 or 8 k's from the city, which again will do well in the next year or two. But if we go through another cycle, the market slows, we get oversupply in 7 to 10 years' time. I think there'll be some issues with that. Brisbane isn't an international city just yet. And it's an area that I think is an opportunity to reconsider for most investors in that price point.
That is interesting as well. And talking about that price point, if we're talking sub 1.1, that is probably 90% of investors' budgets right now, maybe even a little bit higher. Obviously, if you've got opportunities to go that extra amount, you see value. But I've been crunching our 2025 data, and the average purchase price was about 650K, and there's some weird sort of outliers in there that maybe actually drag that up a little bit. So it does beg the question, if you are in and around that 650, or let's just say even sub $1 million mark, where are the opportunities? Maybe we can tell the story of the regions and Melbourne next, because I know you've got a profile there as well. When we look at places like Townsville, that I think actually topped all SA3 locations in 2025, certainly it was number one for our investors, doing like 25%. I mean, that was great, but there's an argument to say, if you weren't there, you've missed it. What's next?
The Geared for Growth Property Investing podcast is presented by our business, MCG Quantity Surveyors. If you're an investor or a property professional looking to get the best tax depreciation deductions for yourself or your clients, please get in touch with us at mcgqs.com.au. It's our mission to help as many property investors as we can to maximise their claims and maximise their property education as well.
Yeah, I agree. I think, like I said before, I wouldn't be going into the regions. I think it's far too risky at this stage of the cycle. Don't get me wrong, I think there's good growth there in the next year or two potentially. Obviously, most property experts and people will suggest the same thing. But, you talk about 25% in 1 year. Well, what's that done over 20 years? That's my concern. If someone's looking to buy a property or invest in a property, it should be a minimum of 10, 15, 20 years they're looking at. So they've got to understand those long-term implications. So that's why I would look at Melbourne. I seriously would. Every market is at least done 70 or 80% over COVID, except for Melbourne. Melbourne's done probably about 20%, if that. And if we get into those entry-level suburbs, I think there's amazing value there, Mike. If we're getting down to kind of that 650 mark, we're kind of focusing north of the CBD. There's a real gentrifying pockets in there, probably about 10 or 12 Ks for a villa. We're not buying apartments in Melbourne just yet, although I do think Melbourne has good value for apartments because building costs have gone up so much, properties haven't risen, so there's going to be an undersupply for a very long time. But, something in a villa in a complex of 3 or 4, great land value, great land content, because the land value is probably $1 million, and you've got 3 on the site, something like that. So you've actually got a good land component. And the next generation of investors, or the next generation of home buyers, which are going to drive that market, are going to be the baby boomers who are, selling the big 4 or 5 bedroom house. They want to downsize into something on one level, low maintenance, with a small courtyard for a dog or something like that. They're staying put. And also the millennials who are now reaching the family formation stage. They've kind of had kids, but they've lived in the inner city, in the apartments and all the trendy suburbs. Mate, they're not wanting to live 50 Ks out of the city. Where you're going to buy a house in Melbourne for $650,000, it's going to be 40 or 50 Ks, miles from anywhere. So they're happy to downsize into something smaller. They've got a spare room for a family member. They've got a little courtyard, all those kinds of things. But they're staying close to coffee shops, restaurants, train lines in and out of the city. And they're trading, all that space for getting into the right place. So I see massive opportunities. And again, we were buying villas in Brisbane 5 years ago for 550 to 600. They're now worth 900. So it's a very similar proposition I'm seeing in Melbourne.
Mate, I'm willing to give you 650 for any of those, just so you do get some growth on your purchase price.
Thank you, mate. And the other one I like, we haven't been buying in this suburb for a long time, probably the last 3 or 4 years. We identified an area that we've been buying for our homeowners for a long time, a little bit further out in Melbourne. It's an outer suburb, probably about 30, 40 Ks, down by the bay, southwest location. And the more we bought there, the more it just really appealed to us. The older people were kind of moving out and downsizing. Young families are coming in, they're renovating, they're knocking over houses. Your landlocked, so anywhere 30 or 40 k's from Melbourne at the moment that you buy, there's a 90% chance you've got pockets of land around you that can still be released and have stage 2 and stage 4 of housing estate. This is landlocked. You can't build any more properties. And it's close to the water, close to the bay. So we recognise that. And then we started seeing the income shifting, going up and changing. Land value started to go up. And I think we've been buying there for about 12 months now. This time last year, we were buying properties, probably in the last 18 months, we were buying properties for about 750. Now we can't get in there for under 820 to 850.
Yeah, wow.
So those little pockets there are exceptional value. You know, Mike, you've been doing this as long as I have. Can you imagine going back all these years ago and saying, "Oh, we can get a house in Melbourne for 830,000 now"? I mean, it's crazy considering where the rest of the market is. So exceptional value in those locations, up to $1 million in Melbourne. And the other outlier that, you know, if you've got a lot of assets in Melbourne, you're not fancy on buying the peak of the market in Brisbane, don't rule out Sydney either. You know, I think entry level around 8 to 900. We're getting some amazing opportunities south of Sydney around that Cogra, Brighton pocket. You know, for a 2-bed, 1-bathroom apartment close to the water. And if you look at the long-term fundamentals there, just like Melbourne's been held back by COVID, the Sydney apartment market also was held back by COVID, because that's generally the first stop and the first port of call for those people coming in the country. But that's now recovering, and it's actually the biggest gap on record between Sydney houses and Sydney apartments. And they're just not building apartments at the moment. So for all these new projects in Sydney to get out of the ground, there's got to be pre-sales made. And as construction costs are going up, prices haven't really kept pace. They're probably about 10 or 15% behind where they should be. So I think there's a nice little sweet spot in there for Sydney as well, if you're looking to that affordability range. And to be upfront, Mike, I would put my money into those international cities as opposed to regional cities for the next 10 to 15 years.
Interesting. And probably even sacrificing the holy grail of house in a region for the same price point of going an apartment. Of course, we're not talking high rise with 8 swimming pools. We're talking about, you know, one of those bomb proof sort of 50s, 60s build.
Absolutely. When they were made to last, the 70s, brick, extra 10 square metres internally, you know, 4 or 6, 8 in the complex. Absolutely. And, yeah, we talked about people get that misconception about a house having land. It's actually not the size of the land, though, is it, Mike? I mean, that's not the value. It's actually the value of the land. So as I said before, you know, if you were to do your numbers in Melbourne and you were going to look at a 650 purchase in Melbourne, you're the depreciation expert. What does it cost to build a house these days?
Well, you'd be talking at least sort of 350 for something basic, sort of more on the project home level. It's things have gone up a fair bit. So you've got 350 there. Absolutely, you've got 350 there. You've got 50,000 commission for the spruiker who's selling it. So that gets you up to 400,000, which means the land value is probably only going to be worth about 150,000. And it might be a 500, 600 square metre block. But if you look at, like I said, a villa in a complex of 3 where the land value is $1 million, that land component is still much stronger. And that's the thing that's going to increase in value. So it's not necessarily the size. It's the value of the land. And as I said before, you can imagine what a waterfront or 2 streets back from the water in Sydney, what that land value and how valuable that land is moving forward as well. Yeah, that's a very, very good point. The value of the land. Yes, you might have a smaller parcel, but it could be worth double per square metre. There's also the de-risked factor of there's not going to be a new land subdivision in Cogra anytime soon. But if you're talking sort of, what would it be, like Melton, west sort of area of Melbourne, there's a lot of paddocks there, right?
Yeah, there is. And you know, even the Cranbournes and stuff, they're all overdeveloped and stuff like that as well. So, and the demographics of those areas are less as well. There's more investors out that location. Their incomes aren't as strong as high. They're not going to be able to push property prices up as much. So those fundamentals start to get back into play now that that sweeping market's taken place, where every property except for Melbourne's gone up in value in the last 5 years.
Let's talk a little bit about Melbourne, and I think I might be able to find a way to contrast it to Brisbane. There was a time where Brisbane, there was a lot of chatter, maybe it was around sort of 2013 to 2015, where it's like, if you compare Sydney's median to Brisbane, the gap is so big that all that can happen is Brisbane to go up. And the same people had to talk about that for 6 or 7 years, for example. So we've talked a little bit about this show on mean reversion theory, right? The idea that if it's, it underperforms what its long-term average is, then it only has one way to go. But that as a theory only works if we're talking apples for apples. But there's an argument to say Victoria is not what it once was. It has gone into an extreme amount of debt. The local economy there is suffering. It's cheap. There's no doubt about that. It seems incredibly cheap. But is this mean reversion theory correct, or are we talking about a fundamentally different Melbourne than existed 5 or 10 years ago?
I think you're right on both fronts.
I love it when you say
it's a very.
You're welcome anytime, Bret.
We'll just end it there, Mike.
Yeah.
No, you're right. I mean, it's a very different market, very different environment. It's almost like the government gets away with something. They have an election, they get away with something more. It just moves further and further along. They get further in debt. I mean, you can't write off the effects of COVID. And here we are 2 or 3 years later. But as you said before, there's some significant issues. That city was locked down for 2 years. Businesses suffered, personal suffer. It was absolutely horrible. So you can imagine it's going to take a fair while to get away from that. In terms of taxes and land taxes and stamp duties and I guess tenants' rights and things like that as well, shifting in a certain direction, they're not nice things. But the way we get around that is focus back on the owner-occupiers, because the owner-occupiers are emotional. They don't care about logic. At some stage, they've missed a 2-year window in that time frame where they've been able to sell and upgrade their home and do all those kinds of things. So I think you could probably tell me better than I can tell you, but what's the average, lifespan for someone living in a home? It was somewhere around 7 or 10 years, wasn't it, before they upgrade? So I think we're probably getting close to that in Melbourne. All those people that are returned to Melbourne and all the overseas people that are now moving back to Melbourne, they've been there for a year or two now. They know the lay of the land, where they want to work. That emotion is going to start to creep into the market. They're not going to care about the government, about land tax, because they're not going to pay it because they're owner-occupier. So it's the emotional element, and I think that's where a lot of smart, scientific, numbers-driven people in the investor community, they kind of miss out on that that emotional element. Even economists, they miss out on emotion. They do a lot of calculations, but you can't underestimate that human emotion and the want to upgrade, the need to upgrade. And look, if we'd have had this conversation 6 months ago, Mike, I'd be telling you nothing's happening in Melbourne. I'd be saying the same thing. It's going to be time. It's going to happen. It's going to happen. But we're actually seeing it on ground level. Towards the end of last year, we had a couple of rate cuts last year. The first homeowner grants kicked in. So that's 600,000 to 800,000. Probably moved, 5 to 7% in the last probably 3 or 4 months, just because there's more people at open homes, there's more competition, and we're really having to. I mean, we're not negotiating on properties anymore. We could find a property at 650 and get it for 630. Now we're having to pay 670, 680 because there's more emotion in the market. And once that happens, and that it's another year or two away, the investors will start to see the numbers again, and the numbers will go up, and the rents will go, and everything will happen. And now that the investors will come back in. But I think, as you said before, it's not just going to happen. It will take time, and that mean reversion does take time, particularly after such an amazing incident like COVID. But look, at the end of the day, if you get back to where we were, Melbourne's an international city. I mean, there's some minor things that have changed there, but it is still an international city. It'll still receive the highest population growth over the next decade out of all the capital cities. So, I'm confident that it's better now. I mean, look, if you're going to buy in Brisbane today, I think or Perth or Adelaide today, you're probably going to be happy in 12 months' time. But I can probably almost guarantee in the next 3 to 5 years, Melbourne will be ahead of those capital cities.
That's good. Well, let's book you in for 3 to 5 years' time. It'll be glory and champagne, or it'll be shame and VB, perhaps, mate.
Exactly.
A point that you made that I want to circle back on, because I think it's very, very interesting and maybe explains a little bit of the story about what's happened with investors in the last couple of years, is that we've seen the rise of markets like Darwin, like Townsville. I would say maybe Ballarat is a modern example where the demand seems to be, and I don't have data to hand, but it seems to be investor focused. But the perennial market performers that aren't just a sugar hit that can do 25% in 1 year and then nothing for 10 or 15, which we've seen in Darwin, we've seen in Perth, for example. There's a difference between owner-occupier demand and the driving force that it creates than just these sugar hit investor markets. But it does seem very alluring to go into a Darwin or a Townsville and like not just double digits, but, you know, like 20% style returns are there for the taking. Can you blame people for chasing these sugar hits and going, well, gosh, like maybe it doesn't do anything in 10 years, but if I revalue and I pull equity, I get to get another one and I'm winning this monopoly game?
Yeah. Look, absolutely. I mean, who wouldn't want an extra 20% on their portfolio, right? And particularly at those kinds of levels. So, I can understand 100%. Again, if you are reinvesting things and taking things, it's a great opportunity. But I just think, it's not sustainable. That's my concern. And generally, what you're finding is, it's not sustainable because investors are buying with their calculator. They're not going to pay too much for a property. The numbers have to be right. And they have to have that emotion to back them up. But whereas owner-occupiers, it's all emotion. They'll pay $50,000 to get into a good school catchment or a good area or a good location. So that's much more sustainable. And again, I think most investors would love a sugar hit at the start. They'd love to get 20%. But I guarantee, if you look at it over a 20-year time frame or even over a 10-year time frame, if that averaged out to be 4% per annum versus a property that just ticked along at 6% per annum over a 10-year period, we're probably talking a couple of $100,000 difference. And if we could get into a better property in a better location, the market moves quicker and things like that as well, then we're able to buy more property as well. The rents continue to grow more as well and represent more opportunity. So I guess that short-term sugar hit is, it's enticing, but I guess what we like to do with our clients is actually sit down and work out where they want to be and actually help them understand if going for one of those types of assets are actually going to help them over the longer term to achieve their longer-term goals. And in many cases, we can find opportunities that will do better.
I think it's fair to say that the typical investor underspends on time to figure out what their end goal is and the strategy to get there, and maybe leans into more like, where's the next hotspot? I've got to chase this growth, right?
Yeah, sometimes fear of loss is greater than fear of gain, if that makes sense. They want to go with the crowd where there's a bit of safety and, like we talk about now. Imagine sitting with someone now who's a new investor and they've just kind of read the reels about Townsville and Darwin and they're going 20%, and I'm trying to talk them into buying into Melbourne. That's a tough conversation. But I guess you've got to be, as Warren Buffett says, be fearful when others are greedy and greedy when others are fearful. And I think in many of those markets, you are getting closer to the top of the cycle. I wouldn't call it greed just yet, but it's a brave person that can do that. And again, a lot of investors want that element of safety. But if you're listening and you are an investor, ask yourself this question, why are you investing? What do you actually want to achieve? And I guarantee it'll be financial freedom and security and safety, but you've got to put a dollar amount to that, unfortunately, because that's what's going to get you there. So if it's 100,000 per annum or 200,000 per annum, first of all, in 20 years' time, 200,000 is probably going to be about, 300,000 because of inflation. So, you've got to work and understand those numbers, and then you've got to actually reverse engineer and understand what you need to do and actually have a plan in place to achieve that, rather than just accumulating properties. We always see clients that have got 3 or 4 properties, but they can't borrow any more money, but they don't have a plan for where they want to be, where they want to go. One property hasn't done well. Should we look at replacing it? So if you've got a plan in place, and it doesn't matter how many properties you've got, you could have 2 properties or 4 properties. If they're working in good locations and good areas and will continue to do so and compound over a 10 to 15 year period, you're a significantly better chance of reaching your end goal. And you're right. I just don't think a lot of investors understand what their end goal is. And I think that's a really critical conversation to have.
And perhaps an opportunity to pause and reflect if you are listening. And of course, it's so easy to chase the shiny object, but really the shiniest object of all is financial freedom and living life on your own terms, right? Let's take a minute, because I know you're a student of economics. From a macro point of view, let me sort of lay out all the puzzle pieces at the moment. We've got our new Liberal leader, and he sort of said in his own words that he's taking over the party at the worst time since it was created in 1946 or whenever it is, and we've got One Nation beating him in the polls. Who would have thought that happened? I saw a chart the other day that said that public demand, as in government expenditure, is roughly about what the expenditure was in terms of nominal percentage of GDP as the mining boom. And of course, that's feeding into inflation. That's stealing trades away from construction. Feeding inflation, of course. We just had our 25 basis point increase. Some banks are saying that could be it. I think most people are saying, look, I'd bank on another 25 basis points.
Agreed.
What's your read of the situation that we're in at the moment? What do you think investors need to know as they're transacting in 2026 and beyond?
I don't care.
Right. Well, that was Bret Warren. Thanks for sure.
Honestly, Mike, if you and I sit down together for a beer in 20 years' time, which we're probably a fair chance to do so, do you reckon any of these topics will come up?
Yeah, I mean, that is funny, isn't it? Because if you look at the property over a 60-year time frame, huge events like GFCs and pandemics are little tiny blips.
Yep. No, you're right. I mean, let's get back into it. I mean, you're right. I mean, the government's out of their depth. They're incompetent. Let's face it. If we look at what they're doing, talk about capital gains, negative gearing, all those kinds of things. They're so incompetent. They're getting back to what we said before about investors. They're just focused on the short term. We've got a housing crisis, and their targets are to reduce the number of investors in the market so they can't provide houses for the community. Like, it's just madness. So anyone that gets in, I mean, the long-term fundamentals are just so one-sided. There's so much demand. There's so many people moving here. Interest rates are relatively cheap. Homeowner grants are on the table. That's just a huge level of demand. We're not building any more properties. We've got to build 200,000 a year. We're not building any. There's construction loopholes. In some areas, we can't construct. Those fundamentals are just so one-sided. And if interest rates go up another 2%, if the capital gains tax thing does come in, if negative gearing does get changed, those investors that are in the market are just going to absolutely smash it, because the market's just going to get away from everybody, and that's a real concern. And again, I don't want that to happen. I'd love that to happen from an investment and numbers perspective. It's not good for our community. It's not good for our social cohesion. You start to get into, I guess, divided classes and start to get into the have and the have-nots, and you lose that middle class that's so vital in Australia because the taxes and things like that as well. So in my mind, it's not going to matter if you get in today what's going to happen in the next 5 or 6 years. I do think inflation will go up. It has to. The government's just spending way too much. But again, they're focused on the short term in the next election rather than providing real solutions longer term. So I sit down and talk with Michael Yardney on a regular basis. He's been doing this for 50 years. We've never, ever really spoken about how he feels about interest rates or what's going to happen if this happens or that happens. I mean, there's discussion around it, but it's not a major concern because we've been playing the game of property investing for 20 odd years, and we just accept that every year the rule's going to change slightly, and we just have to adjust to it, I guess.
It's a good point you raise, and I think that there's so much noise out there, and like I've said in the show a number of times, if you're wanting property advice, the last place to go is probably the newspapers and the media, right?
Yeah.
Because they are just leaning into that noise and sensationalizing it to some degree, but it does sort of seem like many of these episodes that I've done, and I've done hundreds of them now, the answer that I think people take away from it is that it's actually pretty bloody simple when you think about it. You need to find an asset that's well located. It needs to fit the right area. It needs to be in an area that supports income growth with jobs and those sorts of things. And I feel like that's kind of the message that I'm getting from you now as well.
Isn't it boring? It's just boring.
It's hard to run a bloody podcast with this material.
Sorry, mate. I'm trying to ham it up as much as I can. But, it's quite interesting because we sit down with clients. I've sit down with so many clients, and then they've got their home and they've either got 1, 2 or 3 investment properties. Guess which property has been the absolute best performer 9 times out of 10?
It's the one that's tax-free.
They're home. They're home because they've followed the fundamentals. They've followed their hierarchy of needs. They've followed wanting to be close to employment, wanting good infrastructure, public transport, walkability, coffee shop, restaurants. They've got kids. They want to get their kids into the best school catchment. They follow that. Then all of a sudden they feel like they've got to reinvent the wheel, and they find some shiny new project off the plan or a house and land package in the middle of nowhere and think, oh, this is great. But they get away from the fundamentals because the fundamentals are just boring. buy a good property in the absolute best location you can, forget about it for 20 years, and when you want to retire, you'll have your nest egg waiting for you, rather than worrying about interest rates and capital gains and hotspots and not spots and all that kind of thing. So unfortunately, it is boring, and that's my challenge. You know, I'm boring. Our business is boring. We don't have all those other shiny things happening because we just focus on those long-term fundamentals and getting it right.
That is an interesting point. I'd love to see data on that. The people that have held, say, an investment for 20 years versus their owner-occ, which one outperforms? And of course, where you want to live is you're thinking about the lifestyle and the amenities and proximity to things and school catchments and those sorts of things. Like, why should we think differently about an investment property?
Exactly. And why it's interesting. Why do people think differently? It'd be a good social experiment, wouldn't it? Just to think, why do people go away from those really strong fundamentals that they've got right? And that creates demand for property and a shortage of location and supply and things like that as well. It's the perfect ingredient when you think about it. But people feel like they've got to reinvent the wheel a little bit, you know?
Yeah, I love that, mate. In terms of investors listening today that are a little bit bamboozled by the shiny things and don't want to miss out on the next hotspot and hearing about places like Darwin and Townsville and Ballarat and different points of the cycle, but maybe don't have that $1.1 million plus budget. What message do you want to leave with them today?
Yeah, sure. Like I said, if you've got 500,000-600,000 as an entry level, you can get into an international city. I guess, you know, if you just draw it back and, like we just said before, make it boring and make it just simple, go with your gut feel. Would you invest in Melbourne for the next 20 years, or would you invest in an external suburb that might go okay? You know, it really just gets back to those basics. We can still get you an amazing property in an investment grade location that will do exceptionally well. And as you said before, I'm having a lot of discussions with people like I was in Brisbane in 2020 about Melbourne, and it might not happen this year. It might happen in 3 or 4 years, but it will return and it will change. And I think people have got an opportunity to get into a rising market when most of Australia is probably going to be taking a breather over the next couple of years as they hit those affordability ranges and peaks and things like that as well.
Bret Warren, what a way to finish. Thanks, mate. Appreciate it.
Always a pleasure, mate. Always great to catch up.
We'll see you again soon. We've got to get you back in 3 to 5 years to see if you're eating your words, but I doubt it. Thanks, mate.
Well, time will tell.
We'll see. Cheers, buddy.
Thanks, mate.